In September 2008, Lehman Brothers was the fourth largest investment bank in the United States, 158 years old, 28,000 employees, $639 billion in assets. Its CEO, Richard Fuld, had run the firm for 14 years, the longest tenured chief executive on Wall Street. He was known as the Gorilla, feared by competitors, revered by his board, and convinced that Lehman would survive the crisis the same way it had survived every crisis before. On a single Monday morning, it was over. Lehman Brothers filed for the largest bankruptcy in American history. The Dow dropped 4.5%, its worst day since September 11th. Within weeks, the global financial system was in freefall. $10 trillion in stock market value vanished. 8.8 million people lost their jobs. Entire countries were dragged into debt crises that would last a decade. This is not a story about one bank making bad bets. It's a story about what happens when an entire system, the banks, the regulators, the rating agencies, the government, convinces itself that the risks are manageable until the moment they aren't. Lehman Brothers started as a dry goods store. In 1844, a 23-year-old immigrant named Hayam Lehman arrived in Montgomery, Alabama from Bavaria. His two brothers joined him, and by 1850, the business was known as Lehman Brothers. They discovered that cotton farmers preferred to pay in cotton instead of cash, so the Lehmans became cotton traders. By 1858, they had moved to New York. By 1887, they were members of the New York Stock Exchange. Over the next century, Lehman evolved into investment banking, underwriting public offerings for Woolworth, Macy's, and Studebaker. They survived the Civil War, two world wars, the Great Depression, and the dot-com crash. For 160 years, Lehman Brothers adapted and endured. It was the kind of institution that felt permanent. That illusion would end with a single product, the mortgage-backed security. A mortgage-backed security works like this. A bank makes thousands of home loans, bundles them together, and sells them to investors as a bond backed by mortgage payments. Investors get steady income. The bank gets its money back to lend again. Everyone profits. For decades, this system worked. The risk seemed minimal because housing prices had gone up almost every year since the Great Depression. The assumption baked into every model, every rating, every trade was simple. Home prices don't fall. Not nationally, not all at once. Lehman didn't just participate in this market, they went all in. Between 2003 and 2004, Lehman acquired 5 mortgage lenders, giving the firm the ability to originate its own loans. They weren't just packaging other people's mortgages anymore, they were making the loans themselves, bundling them into securities, and selling them worldwide. But here's what made it catastrophic. Lehman kept the worst loans on its own books. The safest mortgages were sold to investors. The riskiest ones, subprime loans to borrowers who could barely afford them, stayed with Lehman. By the end of 2007, Lehman held $111 billion in real estate assets. That was more than double what it held 1 year earlier, and more than 4 times the firm's total equity. Lehman Brothers had made a single, massive, leveraged bet that the American housing market would keep going up. Richard Fuld was not a man who accepted bad news easily. He had survived the Russian debt crisis, the long-term capital management collapse, and September 11th, when Lehman's headquarters across from the World Trade Center was destroyed and the firm relocated overnight. Fuld ran the firm like a fortress. Loyalty was everything. Disagreement was dangerous. When Scott Gelband, the head of fixed income, warned in 2005 that Lehman was carrying dangerously high levels of mortgage debt, Fuld didn't listen. Gelband left. When the housing market cracked in 2007, Fuld doubled down, insisting the worst was over and that Lehman's positions were sound. In 2007, the firm reported $5.6 billion in write-downs, but Fuld told investors the problems were contained. He also rejected multiple opportunities to save the firm. The Korea Development Bank expressed interest in investing. Fuld demanded too high a price. Warren Buffett reportedly explored a deal and walked away. Every potential lifeline was met with the same response. Lehman was worth more than anyone was offering. By September 2008, Lehman's stock had lost 73% of its value. The firm posted a quarterly loss of $3.9 billion, and the short-term funding markets that Lehman depended on, borrowing billions every single day just to operate, were starting to close. The gorilla still believed he could save it. The week of September 8th, Lehman reported its worst results in history. The stock dropped 45% in a single day. Two potential buyers emerged, Bank of America and Barclays. Treasury Secretary Hank Paulson and New York Fed President Timothy Geithner called emergency meetings. The message from the government was clear. There would be no public bailout. Lehman would be saved by the private sector or not at all. On Saturday, September 13th, the negotiations began. Teams from both banks poured over Lehman's books. The clock was ticking. If no deal was reached by Monday morning, Lehman would collapse. Bank of America walked away first. After examining Lehman's exposure, executives decided the risk was too great and announced they would acquire Merrill Lynch instead. Lehman's best chance at rescue was gone. That left Barclays. The British bank was willing to buy Lehman, but under British law, Barclays needed shareholder approval to guarantee Lehman's obligations during the transition. They asked the British government for a waiver. On Sunday afternoon, the answer came from London. Alistair Darling, the Chancellor of the Exchequer, refused. The British government would not expose its financial system to the unknown risks on Lehman's balance sheet. There were no more buyers. At 1:45 in the morning on Monday, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. $613 billion in debt. 26,000 people lost their jobs. Employees who had spent the weekend hoping for a rescue walked into headquarters at 745 7th Avenue to clean out their desks. The collapse did not stay contained. Lehman was a counterparty to financial institutions around the world. The day after Lehman filed, the Federal Reserve lent $85 billion to AIG, the insurance giant that had written hundreds of billions in credit default swaps on mortgage securities. The irony was impossible to miss. The government let Lehman fail on Monday. By Tuesday, it was bailing out the next domino. Within days, the credit markets seized. Banks stopped lending to each other. Money market funds reported losses. The contagion spread from Wall Street to Main Street and across the Atlantic. Congress passed the Troubled Asset Relief Program, TARP, authorizing hundreds of billions to stabilize the banking system. The Federal Reserve cut rates to near zero. It wasn't enough to prevent the worst global recession since the 1930s. The S&P 500 fell 38% in 2008. Home prices dropped 40%. 8.8 million jobs were lost. Ireland, Greece, Spain, Portugal, and Cyprus were pulled into sovereign debt crises. The total cost to the global economy, $10 trillion. Dick Fuld was never criminally charged. He testified before Congress, insisting that the forces that brought down Lehman were beyond anyone's control, a tsunami no one could have predicted. But people had predicted it. Inside Lehman, executives warned about the firm's exposure years before the collapse. Outside, economists sounded alarms about the housing bubble as early as 2005. The rating agencies stamped AAA ratings on securities backed by loans to borrowers who couldn't afford them. The regulators had the authority to intervene and chose not to. Everyone assumed someone else was watching. No senior executive at any major Wall Street firm went to prison for the financial crisis. Not at Lehman, not at Bear Stearns, not at any bank that packaged and sold toxic mortgage securities to investors around the world. The crisis destroyed $10 trillion in wealth, cost nearly 9 million jobs, and reshaped the global economy. And the people who built the machine walked away. $613 billion in debt. 26,000 jobs, 158 years of history. And the only reason anyone noticed the risk was that the housing market did the one thing everyone assumed it would never do. It went down.